Are you exhausted by the stress of stock market volatility and the constant fear of making costly financial mistakes? Discover the transformative journey of Guy Spier, who went from a greedy, high-pressure Wall Street banker to a successful value investor by modeling legends like Warren Buffett and Mohnish Pabrai. This audio overview reveals the secrets to mastering investment psychology, creating an ideal environment to check your emotions, and using checklists to secure long-term wealth. Click to listen and learn how shifting from an outer scorecard to an inner scorecard can lead you to true financial freedom and wisdom. Let's find out more.
It is great to be here. And honestly, I think that introduction sells it a little short. Because when we say investment psychology, it sounds a bit academic, doesn't it?
It really does.
It sounds like we're going to, look at charts and talk about cognitive biases in a really dry textbook way.
Right, it sounds like homework. But having read through the education of a value investor, this feels much more like a confession. Or maybe an exorcism.
That is a perfect way to put it, yeah. It's an exorcism of the ego. This isn't really a book about how to read a balance sheet, although that's in there, of course.
Sure.
It's a memoir about a guy who had everything. I mean, top-tier education, Oxford degree, Harvard MBA, top of his class, and somehow found himself completely morally bankrupt in a boiler room on Wall Street.
And that's the hook for me. That's the part I can't get over. You have this guy, Guy Spier, who is technically a genius. I mean, you don't get to the top of your class at Oxford economics without a serious CPU in your brain.
Absolutely not.
But the story starts with him making arguably the stupidest career decision possible for someone with that resume.
It creates this incredible tension right from page one. We usually assume that intellect is a shield. We tell ourselves, I'm smart, I know right from wrong, I can see through scams, therefore I'm safe.
Yeah, too smart to fall for that.
Exactly. But Spier's journey just completely blows that theory out of the water.
It suggests that environment is actually stronger than intellect. That if you put a genius in a toxic tank, the genius doesn't clean the tank. The tank poisons the genius.
Precisely. And that's really the mission for this deep dive. We're going to track Spier's arc from what he calls the Gordon Gekko phase, where he was just arrogant, greedy, and miserable, to his current state, which is almost, monastic. He's living in Zurich, barely checking stock prices, and modeling his entire life and investing practice after Warren Buffett. But the interesting part is the mess in the middle.
The mess is where all the lessons are. So let's go back to the early 1990s. Set the scene for us. Who is Guy Spier before the fall?
Okay, so you have to picture a young man who is, for lack of a better word, glowing with potential. He's finished Oxford. He's just finished his MBA at Harvard Business School. He is the absolute definition of the elite.
The best of the best.
But internally, he describes himself as incredibly arrogant and at the very same time incredibly insecure.
Which is such a dangerous combination.
The most dangerous. Because the arrogance makes you think you know everything, and the insecurity makes you desperate for validation. He wanted to be a master of the universe. He didn't want to, slowly build a business. He wanted to be a deal maker.
He wanted the movie version of Wall Street.
Yes. The yellow tie, the suspenders, the power lunches. He was looking for a shortcut to massive, immediate wealth.
And this desire for the shortcut is what blinded him. Because with a Harvard MBA, he could have gone to Goldman Sachs, he could have gone to McKinsey, any of the top-tier firms. But he didn't. He went to a place called D.H. Blair.
D.H. Blair. Now, for those who weren't on Wall Street in the 80s and 90s, that name carries a very specific stench.
It's a bad reputation.
A terrible reputation. It was known as a chop shop. But to a young, greedy Guy Spier, it looked like a rocket ship.
So why? If it was so notorious, how did they hook him? How does a Harvard MBA not see the red flags?
The sizzle. It was all about the sizzle. Spier talks about his interview with the chairman, J. Morton Davis. They called him Morty. And Morty was a legend in his own mind. He had this office right next to the J.P. Morgan building on Wall Street. I mean, think wood-paneled walls, deep carpets, hushed tones. It projected immense power and legitimacy.
So it looked the part. It had the right address.
It looked exactly like the movies. And Morty was a master manipulator. He sat Spier down and he told him, look, at Goldman, you'll be a cog in a machine. You'll be carrying briefcases for 5 years. Here, you'll be doing deals on day one. You eat what you kill.
And for a young guy with a massive ego and that insecurity we talked about, that is absolute catnip. I'm special. I shouldn't be a junior analyst. I should be a deal maker now.
Exactly.
Yeah.
He ignored all the warning signs, the bad press, the regulatory issues, because his greed was screaming louder than his logic. But here's the reality check. D.H. Blair wasn't really an investment bank in the traditional sense.
Okay.
It was effectively a high-pressure sales machine, a boiler room, that specialized in taking garbage companies public and then dumping the stock on unsuspecting retail investors.
We need to dig into the mechanics of this, because I think people hear boiler room and they think of, the Wolf of Wall Street guy screaming on the phone, but they don't understand how a Harvard grad fits into that. He wasn't on the phone cold calling grandmothers, was he?
No, and that's the most insidious part. He wasn't the guy on the phone. He was the Ivy League fig leaf.
The fig leaf. Explain that.
Think about it. If you are selling a sketchy company that has no revenue and a dubious product, how do you make it look legitimate?
You get a stamp of approval from somewhere respectable.
Exactly. You hire a guy with Harvard and Oxford on his resume to write the research report. You put him in the meetings with the CEO. His job wasn't to actually analyze the company. His job was to sanitize it, to lend his credibility to the scam.
Wow. That makes my stomach turn. So he wasn't just working at a bad place. He was an active ingredient in the poison.
He calls himself a high-class shill. And there's this one anecdote that just captures the whole dynamic perfectly. It's the cold fusion meeting.
Oh, this story is wild. Yeah, walk us through this.
So, Spier sitting in a boardroom. D.H. Blair is preparing to IPO a company that claims to have discovered cold fusion. Now, just a quick physics refresher for everyone.
Please.
Cold fusion is the holy grail of energy. It's basically infinite, clean, free energy at room temperature. It's also, according to mainstream physics, pretty much impossible, or at least nobody's ever made it work in a repeatable way.
Right. If someone actually solved cold fusion, they wouldn't be at a second-tier investment bank in New York. They'd be in Stockholm accepting a Nobel Prize and changing the world.
Exactly. And Spier knows this. He's smart. He's got a science background from Oxford. He's looking at the prospectus. He's looking at the scientific claims, and the numbers are just laughable. The science is complete gibberish.
So what does he do? He's sitting in this meeting with the company's management, his bosses.
He laughs. He literally chuckles in the meeting. He turns to the other bankers and the management team, and he's essentially thinking, okay, guys, funny joke, cute story, but seriously, what are we really selling here?
He thinks he's in on the joke with them.
He thinks the room is rational. But then he looks up, and nobody else is laughing. The room goes ice cold. The CEO of the cold fusion company is glaring at him. The other D.H. Blair bankers are staring daggers at him.
Because he broke the fourth wall. He pointed out the emperor has no clothes.
He broke the trance. And in that one moment, he realized that nobody else in that room cared about the laws of physics. They didn't care if the product was real. They only cared about one single thing. Can we sell this story?
That must be such a terrifying, isolating feeling, to realize you are the only person in the room who is tethered to reality and everyone else hates you for it.
It's the definition of gaslighting. And the tragedy is, Spier didn't flip the table and walk out. He shrank. He apologized. He thought, maybe I'm wrong. Maybe I'm the idiot here. But deep down, he knew. He knew he was helping them sell a lie.
And it wasn't a one-off, right? There was another one, too, the space station deal.
Oh, yeah. This one might have been even more absurd. They were taking a company public that claimed they were going to build a private space station.
A private space station.
Yes. Using leftover hardware from a former Soviet republic. I mean, it's pure science fiction. But it had that sizzle. It captured the imagination. And D.H. Blair knew they could sell stock in a space station company to dentists in Ohio who wanted to feel like they were part of the future.
It's predatory. It's selling a dream, is a fantasy.
It's entirely predatory. But, the moment that really broke Spier, the thing that finally pushed him over the edge, wasn't the fake tech. It was when he tried to do a real deal.
The telechips deal.
Right. So Spier is desperate at this point to prove he's not just a shill. He finds a legitimate Korean company called Telechips. Real revenue, real product, real engineers.
Okay, a real business.
A real business. He flies to Korea. He wines and dines the CEO. He builds trust. He sits down with the guy and shakes hands on a deal. We will take you public at this price with these fees.
He gave his word.
He gave his word. As a representative of D.H. Blair, he flies back to New York, feeling great, sets it all up. And at the 11th hour, literally right before the deal is supposed to close, the partners at D.H. Blair step in.
Oh, no.
They look at the file and they basically say, no, we're changing the terms.
They squeezed them.
They realized the Korean client was desperate for the cash and had no other options left. So D.H. Blair unilaterally lowered the valuation of the company and jacked up the fees. They just gouged the client because they could.
And Spier had to be the one to deliver the news.
He had to get on the phone with the man he had looked in the eye and say, I lied. Or effectively, the deal I promised you is gone. Here's the new terrible deal, take it or leave it. It completely destroyed his reputation with the client.
Yeah.
And that was the moment Spier realized he was on a moral cliff.
He describes feeling sullied. That's the word he uses. Like he needed a shower that he couldn't take.
He realized that if he stayed there, he wouldn't just be a guy working a bad job. He would become one of them. His soul was actually at risk. And he quit.
Which brings us back to that core question, though. How does this even happen? We touched on it in the intro, but I really want to push on it. He went to Harvard Business School. He went to Oxford. Shouldn't that education have given him the tools to spot a boiler room? Or at least the ethical framework to avoid it?
You would absolutely think so.
Yeah.
But Spier devotes a whole section of the book to what he calls the perils of an elite education.
Okay.
And he argues that schools like Harvard and Oxford, they train the neocortex, the analytical, logical, rational part of your brain. They teach you to build complex financial models. They teach you how to debate game theory.
But they don't teach you street smarts. Or maybe soul smarts.
Exactly. They completely ignore the reptilian brain, the part of you that is driven by primal forces, fear, greed, social pressure, envy, the desire to be in the in-group. Spier was an intellectual giant, but an emotional infant. He had no defense mechanisms against a master manipulator like Morty Davis, who was appealing directly to his greed and ego.
There's also a specific piece of academic dogma they taught that really blinded him. The efficient market hypothesis.
Oh, this is such a huge academic trap. So at Oxford and Harvard in those days, the prevailing economic theory was that markets are efficient.
Meaning
Meaning that stock prices at all times reflect all available information. Therefore, no stock is ever truly cheap or expensive. It's always priced correctly right now.
So if you believe that, then trying to beat the market by finding undervalued stocks is a total waste of time.
It's a fool's errand. And if you believe that, then Warren Buffett is impossible.
Right. If the market is perfectly efficient, Buffett is just a statistical anomaly. He's a guy who flipped a coin and it came up heads 50 times in a row. It's pure luck, not skill.
And Spier believed this. He was so indoctrinated by his professors that he dismissed the greatest investor of all time. And this leads to this painful story. Honestly, it makes me cringe every time I read it, where Warren Buffett actually came to Harvard Business School to give a guest lecture while Spier was a student there.
You're kidding me. The Oracle of Omaha is in the building, and this future value investor.
Doesn't even sit down. He stands in the back of the lecture hall, totally distracted. He admits he was more focused on a girl he had a crush on than on listening to Warren Buffett.
Unbelievable.
But it was worse than just being distracted. It was arrogance. He looked at this folksy old man from Nebraska talking about value and management, and he thought, this guy's a dinosaur. I know the math. The math says he's just lucky. This isn't for me.
Wow. Talk about a misconnection. He literally walked right past the answer to all his future problems because his elite education had told him the answer couldn't possibly exist.
It's such a profound lesson in humility. The very education that was supposed to open his mind had actually slammed it shut to the most important ideas.
So Spier eventually hits his moral wall. He quits D.H. Blair. But he doesn't just walk into a golden parachute at another firm.
No, not at all. He is damaged goods. In the small, insular world of Wall Street, reputation is currency. And having D.H. Blair on your resume in the early 90s was like having a felony conviction. It marked you as tainted.
So the top firms.
The top firms, Goldman, Morgan Stanley, they wouldn't touch him. He was radioactive.
And this is what he calls the firewalk phase. He's unemployed. He's living in New York. He feels like a complete and utter failure.
He describes this period of just wandering around Zuccotti Park in Lower Manhattan. He's buying falafel from street carts because he's trying to save money. He's playing chess with strangers in the park all day. It's a total identity collapse. He went from being this master of the universe wannabe to just a guy killing time in a park, feeling like his life was over.
But rock bottom is so often where the new foundation gets built, right?
It is. In that boredom, in that desperation, he wanders into a bookstore. And he stumbles upon two books that change his life. Benjamin Graham's The Intelligent Investor.
The Bible of Value Investing.
And Roger Lowenstein's biography of Warren Buffett, The Making of an American Capitalist.
And this time, because he's been humbled, because he's been broken, he actually reads them with an open mind.
The scales just fell from his eyes. He realized that what Buffett was doing wasn't luck. It was a system. It was a repeatable process. But more importantly, he realized it was a moral system.
Okay, how so? How is buying stocks a moral act?
Well, think about the contrast. D.H. Blair was all about transactions. It was about ripping someone's face off today to make a quick buck. There's no long-term view.
Right.
Value investing, the way Graham and Buffett practice it, is about partnership. It's about finding a good, honest business, buying a piece of it at a fair price, and then holding on for 10, 20, 30 years. It requires patience. It requires trust. It requires you to treat the management of the company like your partners, not like targets to be exploited.
It was the perfect antidote to the poison he had just swallowed at D.H. Blair.
Exactly. It offered him a path to be successful without selling his soul. He realized he could win by being the tortoise, not the hare.
So he's found his new path. He decides to start his own fund, the Aquamarine Fund. He scrapes together money from his family. His dad, Simon Spier, is his first investor.
Which puts a very real and personal pressure on him. It's one thing to lose a stranger's money. It's a whole other thing to lose your father's retirement savings.
For sure. And he makes his first real value investment. It wasn't some high-tech, sexy company. It was Burlington Coat Factory.
And this is such a great example of the mental shift. At D.H. Blair, he was looking for sizzle space stations and cold fusion. Burlington Coat Factory is coats. It's a warehouse in New Jersey selling discounted winter jackets.
It's as unsexy as it gets.
It is profoundly boring, but it's real. It's a tangible business with real cash flow. And Spier actually drove to the warehouse. He walked the aisles. He touched the coats. He saw the customers buying the coats. And he had this epiphany. I own a piece of this. This is a real thing. It grounded him in reality in a way that selling fake space station stock never could.
So he's found the path. He's a value investor now. He's made his first investment. Cue the happy music. Roll credits.
Not quite. Not even close. Because, and this is really the crux of the entire book, intellectually understanding value investing is the easy part. Emotionally living it, day in and day out, is incredibly hard.
Especially when you are living in what he calls the New York vortex.
Vortex, yes. This is section 4 of our deep dive. Because even though he had the right strategy in his head, he still had the wrong environment and, frankly, the same old ego.
He was still in New York City. He was still hanging out with his Harvard classmates. And this brings us to the green-eyed monster, envy.
A huge, huge theme in the book. He specifically mentions guys like Bill Ackman and Chris Hahn. They were in his class at Harvard. And they weren't just doing okay, they were becoming billionaires.
They were on the cover of magazines. They were managing billions and billions of dollars. And Guy Spier was managing, maybe 15 million, then 50 million. In the real world, Spier was a rich man. In his world, compared to his peers, he felt like a pauper.
This comparison trap is so powerful and so relatable. It doesn't matter if you're a banker or a baker. If you look at your peer group and they seem to be winning more than you are, it creates a physical pain. It feels like you're losing.
And to compensate for that feeling, Spier started acting out. He fell right back into the trap of the outer scorecard.
Okay, we absolutely need to stop here and really unpack this. The inner scorecard versus the outer scorecard. This is the core philosophical concept of the entire book.
He gets it from Buffett.
He eventually learns it from Buffett, yes. But in this phase of his life, he was violating it every single day. The outer scorecard is when you measure your self-worth by how other people perceive you.
So do people think I'm smart? Do people think I'm rich? Am I on the cover of Forbes? Do I have a bigger fund than my classmates?
Exactly. It's all external validation. The inner scorecard is the opposite. It's, did I do a good job today according to my own standards? Did I act with integrity? Am I a better investor today than I was yesterday? It's an internal measure.
Buffett has this very strange but brilliant analogy for it, the lover test. I want you to walk us through that because it's such a provocative question.
It's brilliant because it's so clarifying. Buffett asks, would you rather be the world's greatest lover, but everyone in the world thinks you're the worst? Or would you rather be the world's worst lover, but everyone thinks you're the best?
It just stops you in your tracks.
It really does. Because if you choose the second option, being the worst, but known as the best, you are admitting that you care more about your reputation than your actual performance. You care more about the applause than the reality. You are living 100% by the outer scorecard.
But choosing the first one, being the greatest lover, but having everyone whisper that you're terrible, that requires an insane level of self-assurance. You have to be so confident in your own reality that the public opinion doesn't touch you at all.
And that is exactly how Buffett invests. Think about the dot-com bubble in 1999. Everyone was buying Pets.com and making millions overnight. Buffett wasn't buying any of it. He was sitting on the sidelines.
And the press was crucifying him.
They wrote articles saying, has Buffett lost his touch? Is he senile? The game has passed him by. In the public eye, he was the world's worst investor that year.
But his inner scorecard was fine.
He slept like a baby because he checked his inner scorecard. He looked at the math, he knew the tech stocks were a bubble, and he knew he was right. He didn't need the applause.
Spier, at this point in the story, absolutely did not have that strength. He was desperate for the applause.
He was starving for it. He rented an office he couldn't afford, $250,000 a year on Madison Avenue, just to look successful. He bought a Bloomberg terminal, which cost $20,000 a year back then, not because he needed it, but because real traders have Bloomberg terminals.
He calls it informational crack cocaine.
It is. It flashes red and green lights all day long. It gives you breaking news headlines every second. It's designed to stimulate the reptilian brain and trigger a fight-or-flight response.
It makes you want to do something.
Exactly. But for a long-term value investor who's supposed to hold stocks for 10 years, it's pure poison. It just creates anxiety and encourages activity for activity's sake.
And this need to look smart and play the game led him into a really toxic battle, the Farmer Mac story.
This is such a great cautionary tale. He teamed up with his old classmate, Bill Ackman, to short sell a stock called Farmer Mac. Shorting, for those who don't know, means you are betting the stock will go down.
Which is already kind of a negative posture to take. You are actively rooting for failure.
Right. But they didn't just bet against it. They went on a public crusade. They wrote open letters to the regulators. They called reporters from the New York Times. They were trying to actively destroy the company's reputation to make their short trade work.
Spier cast himself as an avenging moral crusader.
And he was miserable. He talks about waking up in the middle of the night, heart-pounding, stressed, angry, checking the stock price on his BlackBerry. He realized that this antagonism was just corroding him from the inside. Even if he made money on the trade, he was losing his peace of mind.
He wasn't compounding money. He was fighting battles. He was at war.
But that's not why he got into value investing. He wanted freedom and peace, not constant warfare.
So he's struggling. He's got the fund. He has the right intellectual framework. But he's stressed out and consumed by envy. And then he meets someone who changes his trajectory again. Section 5. Meeting a master. Enter Mohnish Pabrai.
Mohnish is such a fascinating and important character in this story. He's an Indian IT entrepreneur who sold his company for a lot of money and decided to become an investor. And he is completely, totally, unapologetically a cloner.
Cloning. In creative fields or academia, that's a dirty word, it's plagiarism. You're taught to be original.
It is. We are all taught that you have to be original. You have to have a unique insight that nobody else has. But Mohnish looked at the world of investing and said, wait a minute, Warren Buffett has already figured this out. He has a 50-year track record of success. Why on earth should I try to reinvent the wheel? I'm just going to do exactly what he does.
It sounds so simple, but it requires a total and complete lack of ego.
That's the key. Mohnish has no ego about being original. He openly and cheerfully admits, I am a shameless cloner. And he taught Spier this incredibly liberating lesson. You don't need to be a genius to be rich. You just need to be humble enough to copy the geniuses.
It's liberating. It takes all the pressure off. You don't have to be the smartest guy in the room. You just have to be smart enough to follow the smartest guy in the room.
Exactly. And their friendship started with a very simple, old-fashioned gesture. Spier read an article about Mohnish and just wrote him a thank you note, not an email, a real handwritten letter.
The power of a handwritten note.
Mohnish was so impressed, he called him immediately. They became fast friends. And Mohnish really pushed Spier to align his actions with his stated values. The biggest move was changing the fee structure of his fund.
Okay, this is a bit technical, but we really need to explain it because it's a huge ethical shift for him.
So the standard hedge fund model is 2 and 20. The manager takes a 2% management fee on the total money every year, regardless of performance, and then 20% of any profits.
So if I give you $1 million, you take $20,000 off the top immediately, even if you go on to lose the rest of it for me.
Correct. It incentivizes asset gathering, not performance. Your main goal is to get as much money under management as possible so you can collect that fat 2% fee. Mohnish told Spier, that's the outer scorecard. That's greedy. If you want to be like Buffett, you have to use the original Buffett partnership fees.
And what were those?
0% management fee.
Zero.
Spier gets paid nothing for showing up. He covers his own office rent. He covers his own light bill and research costs. He only gets paid if he makes money for his investors. And even then, he only takes a 25% cut of the profits after the investors have earned a 6% return first.
That is terrifying. You could work for a whole year, work your butt off, and if the market is flat or down, you earn $0.
It's absolutely terrifying.
Right.
But it forces total alignment of interests. It proves to his investors, I am eating my own cooking. I only win if you win. It killed that greedy impulse and forced him to focus purely on generating real long-term value.
It's walking the walk, not just talking the talk. And this friendship with Mohnish, this journey of alignment, it all culminated in the ultimate fanboy moment. Section 6, lunch with Warren.
The $650,100 lunch.
That is a very expensive steak.
It was a charity auction for the Glide Foundation in San Francisco. Spier and Mohnish decided to pool their money, and they won the bid to have a private lunch with Warren Buffett in New York City.
Now, the cynic could immediately say, that's a ridiculous waste of money just by $650,000 of Berkshire Hathaway stock. But Spier says it was the best investment he ever made. Why?
Because they weren't buying stock tips. Buffett isn't going to lean across the table and whisper a secret ticker symbol in your ear. They were buying an education in being. They were there to observe a master of the inner scorecard in his natural habitat.
So set the scene for us. Where does this lunch even happen?
It's Smith & Wollensky in New York, a classic old-school steakhouse. And the first thing Spier notices is how completely normal it all is. Buffett just walks in. No entourage, no bodyguards. He's just a friendly old man in a slightly rumpled suit.
And what does the world's richest, most famous investor order?
A medium-rare steak with a side of hash browns and a cherry Coke.
A cherry Coke.
He is completely 100% comfortable in his own skin. And that was the first big lesson for Spier. Congruence.
Yeah.
Buffett is the same person at a $600,000 lunch as he is sitting on his couch in Omaha watching football. He isn't putting on a show. And Spier realized how much energy he, Spier, was wasting every day trying to perform success, whereas Buffett just was successful.
There was a specific conversation they had about a man named Rick Guerin. This is a fascinating piece of investing lore that I had never heard before.
It's a tragedy, really, and a powerful lesson. We always hear about Warren Buffett and Charlie Munger, the dynamic duo. But in the early days, back in the 1960s, it was actually a trio. It was Buffett, Munger, and a guy named Rick Guerin. And all three of them were compounding money at incredible rates.
So what happened to Rick? Why isn't he a household name like the other two?
Spier and Mohnish asked Buffett that exact question. What happened to Rick? And Buffett's reply was so simple and so chilling. He just said, Rick was in a hurry.
In a hurry to get rich.
Yes. In the big market crash of 1973-74, the market went down hard. Rick Guerin had been using a lot of margin loans. He was borrowing money to buy more stock, trying to juice his returns and get rich faster. When the market tanked, he got a margin call. The bank called and demanded their money back, which forced him to sell his Berkshire Hathaway shares at the absolute bottom of the market to pay back the loans.
Not completely wiped out.
Wiped out. He's a genius investor. He was just as smart as Buffett and Munger. But he lacked the patience. Buffett said, Charlie and I always knew we would become incredibly wealthy. We were not in a hurry to get there. We just knew it would happen eventually. Rick wanted it to happen right now.
That is such a powerful distinction. Rich for sure versus rich right now.
And trying to get rich right now usually leads to broke right now. That story, Spier says, completely cured him of his need for speed. He realized that survival is the single most important skill in investing. If you just survive the downturns, the compounding takes care of the rest.
So the lunch basically gave him permission to stop pretending, to stop comparing. He realized, I can't be Warren Buffett, no one can, but I can be the best version of Guy Spier. And interestingly for him, being the best Guy Spier meant leaving New York entirely.
Which brings the whole story full circle. He finally deeply understood that environment trumps intellect. New York City, the noise, the frantic energy, the constant comparison, the outer scorecard feedback loop was extremistan. It was an environment that triggered all his worst instincts.
So he moves his family and his fund to Zurich, Switzerland.
Which he describes as mediocristan. It's quiet. It's boring. The trains run on time. People aren't obsessed with the stock market. It allowed him to create a crucial physical and psychological distance between himself and the noise of the market. It was his own personal Omaha.
It's not just about changing cities, though. He specifically designed his physical space, his office, to protect his own brain from itself. He calls his office a library.
It's a sanctuary. There's no phone ringing off the hook. There's no cable news blaring in the background. And remember that Bloomberg terminal, the informational crack cocaine?
Yeah, he must have finally gotten rid of it.
He kept the terminal because he still needs the data for research.
Sure.
But he turned the monitor off.
He turned it off.
He realized that the flashing red and green numbers were just a stimulus designed to trigger his reptilian brain to act. Price down, panic, sell, price up, Greed. Buy. By turning the monitor off, he removed the stimulus. He says he checks stock prices maybe once a week, sometimes less.
That's incredible. It's like a recovering alcoholic keeping the liquor cabinet, but it's locked and they've thrown away the key.
Exactly. He knows his brain is flawed, so he builds a system to remove the temptation.
Right.
He also instituted a nap room.
The nap room. I love this part.
It sounds indulgent, but it's completely strategic. Buffett has that famous line, "I tap dance to work." If Spier feels tired or grumpy or his head feels foggy, he doesn't force himself to sit there and analyze a complex 10K filing. He goes into the nap room and sleeps for 20 minutes. He realized that decisions made when you are tired or emotional are almost always bad decisions.
So he's optimizing for decision quality, not for hours worked.
100%.
But even with the perfect quiet library and the nap room, he still needs a way to filter out bad ideas. And this brings us to the most tactical tool in the book, the checklist.
This is a huge takeaway. It's inspired by the surgeon Atul Gawande and his book, The Checklist Manifesto. Surgeons use checklists so they don't accidentally operate on the wrong leg. Pilots use them so they don't forget to lower the landing gear. Spier realized investors need them so they don't buy stupid stocks out of emotion.
But his checklist isn't just generic rules like buy low, sell high. It's a list of his own failures.
He calls it a catalog of past stupidities. He and Mohnish went back and analyzed every single one of their losing investments to figure out what went wrong, and then they turned that lesson into a checklist item.
Give us an example, the smart balance rule.
So early on, he lost a lot of money on a company called Smart Balance, a butter substitute. The stock had dropped 50% from its high. And Spier's brain immediately said, it's half off, it must be a bargain. This is a classic cognitive bias called anchoring. He was anchored to the old high price.
Right. He thought it was cheap only because it used to be much more expensive.
But the company's fundamentals were deteriorating, and it was actually still overvalued. It just kept dropping. So now he has a rule on his checklist. Is this stock cheap in absolute terms based on its current cash flow and assets? Or does it just look cheap because I'm comparing it to a past price?
That is such a critical distinction.
Right.
What about the salesman rule? That one's pretty simple.
Simple and powerful.
Yeah.
Is someone with a vested interest trying to sell me this idea? If a broker calls him with a hot stock tip, the answer is an automatic, non-negotiable no.
Because if it was such a great idea, they would just keep it for themselves.
Or they would have sold it to their best clients already. If they're calling you, it means they need a buyer, which means you should probably be a seller. Spier only buys stocks that he discovers through his own quiet research. He never ever buys a pitch.
And then there's a more subtle one, the Tupperware rule. This one feels more sociological than financial.
It is. He bought Tupperware stock because the financials look great. Had a cheap PE ratio, it paid a good dividend, but he ignored the health of the underlying ecosystem. Tupperware relies on a multi-level marketing system of people, mostly women, hosting parties.
Right.
That model was starting to break down. The sellers weren't making enough money anymore. The parties were becoming less popular. The ecosystem wasn't a win-win anymore.
It was a win for the company, but a lose for the salespeople.
Exactly. And he realized that for a company to survive and thrive long-term, it must be a win-win for everyone involved. The customers have to get good value. The employees have to be treated fairly. The suppliers need to be healthy. And then, and only then, can the shareholders win. If the company is squeezing any part of that ecosystem, like D.H. Blair squeezed its clients, eventually the whole thing will blow up.
So he checks the health of the entire ecosystem, not just the numbers on the balance sheet.
It's a much more holistic approach to investing.
We've covered a massive arc here. From the boiler room to the library in Zurich. From the outer scorecard to the inner scorecard.
It really is a journey of self-acceptance. And Spier ends the book by admitting he's not perfect. He's not some monk living on a mountaintop. He still drives a Porsche. He likes fancy coffee machines.
See, human, he still has an ego.
But now he acknowledges his flaws. He knows he has a monkey brain that wants to gamble and show off and chase shiny objects. So he builds guardrails. He moves to Zurich. He uses checklists. He surrounds himself with honest, rational people like Mohnish who keep him grounded.
And that's the final takeaway for you, the listener. You don't need to be a hedge fund manager to apply these lessons.
Not at all. The question is, where is your outer scorecard making you miserable? Are you buying a car you can't afford to impress your neighbor? Are you taking a job you hate just for the fancy title?
And what checklists do you need in your own life? Do you need a rule to never make a big financial decision when you're emotional? Do you need a rule to wait 24 hours before any large online purchase?
Build your own Zurich. Create an environment around yourself, both physical and mental, where it's easy to be rational and hard to be stupid. That is the real secret to long-term wealth and happiness.
Guy Spier's journey proves that while you can't easily change your brain, you can certainly change where you put it.
Well said. That's the whole lesson.
Thank you for watching, all. Please like, share, subscribe, follow up in next topic. Come back to continue the education of value investor. It is really good to have you here with us.
It is good to be back.
So, just to set the stage for everyone listening, and look, if you were with us for part 1 of this deep dive, you know exactly what I'm talking about. We watched Guy Spier undergo this massive, almost, well, Hollywood-style transformation.
Clearly was.
He went from being this brash, arrogant, Gordon Gekko wannabe. I mean, essentially a guy who thought the point of life was to die with the most toys.
Right, the guy who's just constantly checking his reflection in the window.
Exactly. And he transforms into a devout disciple of Warren Buffett.
It was a complete philosophical rewiring. He moved from what he calls the outer scorecard, which is, all about impressing other people, getting the approval, the flash to the inner scorecard.
This is about living by your own standards, your own internal compass.
Right.
And that's a beautiful story. It's inspiring. It really is. But here is the problem with philosophical transformation.
Oh, there's always a problem.
They are really easy to have when you're sitting in a comfortable leather chair reading a book.
Or when the market is going up 20% a year. Everyone is a philosopher in a bull market.
Exactly. Everyone is a genius when the wind is at their back.
Yeah.
But today we are moving from the classroom to the battlefield. We are covering chapters 7 through 13 of the book, and this is what Spier calls the fire walk. Because right after he decides to be this Zen Buffett-style value investor, well, the world effectively ends.
The global financial crisis of 2008.
The great financial crisis. And this isn't just a story about, oh, my stocks went down a bit. This is a story about staring into the absolute abyss.
It really is.
We are going to look at how Spier survived the void of 2008 psychologically and financially. But more importantly, we're going to break down the specific nitty-gritty tools he built after that trauma to make sure he never got that close to the edge again.
And nitty-gritty is exactly the right word here. We aren't talking about vague affirmations or, thinking positive. We are going to talk about environmental design. Why he moved his entire family to Zurich. And spoiler, it wasn't for tax reasons, but for mental hygiene.
Right.
Why he starts to treat investing like a game of high-stakes bridge.
And the checklist.
The famous checklist. If you take one single thing away from this deep dive, it should be the checklist.
I agree.
It's this profound realization that having a high IQ and a Harvard MBA doesn't protect you from stupidity. You can drive your portfolio right off a cliff while being the smartest guy in the room if you don't have the right fail-safes.
So let's dive right into the deep end. Section 1, the crucible.
The crucible is the perfect word for it. Because up until 2008, you're right, Spier's transformation was theoretical. He had met Mohnish Pabrai, he had bid on the lunch with Warren Buffett, he had set up his fund, Aquamarine. He sort of felt like he had the answers.
He had the playbook.
He had the playbook, and then the market started to crumble.
And we aren't just talking about prices dropping. That's one thing. We are talking about the actual plumbing of the entire global financial system exploding. Let's go back to March 2008. The Bear Stearns scare. Now, in the movie version of the financial crisis, this is usually the opening scene where people start running around with boxes. But for Spier, this was terrifyingly specific. His fund, Aquamarine, used Bear Stearns as a custodian.
Right. And we really need to pause here and drill down into this because custodian is one of those boring back-office financial terms that nobody thinks about.
Until it's the only thing that matters.
Until it becomes the most important word in the English language.
Break that down for us, because I think most people, myself included, assume that if I have a broker and I own shares of Apple, I own those shares. If the broker goes bust, okay, it's a hassle, but I still own the Apple shares. Why was Spier sweating bullets?
In theory, you are absolutely right. Client assets are supposed to be segregated. They aren't the bank's money. The bank is just holding them for you in trust. But in a catastrophic failure, like what was happening with Bear Stearns, there is a massive, massive gap between theory and reality. When a bank the size of Bear Stearns fails, it's like a black hole. Everything just gets sucked in.
The plumbing breaks.
The plumbing breaks, exactly. If the custodian declares bankruptcy, those assets don't disappear into thin air, but they can get frozen, completely frozen. They get locked in the machinery of the bankruptcy court.
So it's like, imagine you have your life savings in a safe deposit box. But the bank that owns the building catches fire, collapses, and the police tape off the entire block for a crime scene investigation.
That is the perfect analogy. You know your money is in there. You know it's technically yours.
Yeah.
But you can't get to it.
And you can't get to it for how long? A few days.
Could be months. Could be years. And for a hedge fund manager like Spier, that is death. It's just game over. If you cannot trade, if your investors call you and say, hey, I need my money back, and you have to say, well, I can't access it, you are out of business.
So he's just sitting there watching the news, watching CNBC, realizing that even though he didn't use leverage, he didn't borrow money to buy stocks, he was being a quote-unquote safe value investor.
He was doing everything by the book.
He could still be wiped out, just completely wiped out because the guy holding the bag was collapsing.
It was a true existential threat. He describes it as a bullet-dodged moment. He spent that entire weekend in March 2008 essentially waiting to see if his career, his entire fund, was over.
And then what happens?
And then at the 11th hour, J.P. Morgan Chase steps in to acquire Bear Stearns, effectively bailing them out with a lot of help from the government.
And Spier's reaction to that is priceless.
He said he felt a physical, visceral impulse to hug Jamie Dimon, the CEO of J.P. Morgan.
Which is a sentiment I don't think many people shared in 2008. You know, bankers weren't exactly popular. But in that context, Dimon was the Coast Guard showing up while the ship was sinking.
It was pure, unadulterated relief. But here's the thing about 2008. The relief didn't last. Bear Stearns was just the appetizer.
It was just the warm-up act.
The main course was Lehman Brothers later that year in September.
And this is where the story shifts. Bear Stearns was a business risk. It was about the fund, about the plumbing. Lehman Brothers. That was personal. That was about family trauma.
It is the emotional core of this entire section of the book. You have to remember, Spier's father wasn't just his dad. He was his biggest investor. He was the anchor of the fund. He was the reason Spier was able to start Aquamarine in the first place.
Right. So his dad's trust is everything. And in September 2008, as the rumors are swirling that Lehman is insolvent, that it's going under, his father calls him.
He calls Guy and asks a very simple question. Do you think Lehman Brothers will go bankrupt? Now, Guy Spier had been tracking this like a hawk. He was a professional. He'd seen the presentations by David Einhorn, the famous short seller who was basically shouting from the rooftops about Lehman's accounting trick.
So Spier knew it was toxic.
Oh, he knew. He wouldn't touch it with a 10-foot pole. He knew it was a house of cards.
So when his dad asks, Guy probably thinks, Dad keeps up with the news. He's just curious. He wants my expert opinion on what's going on.
Exactly. He assumes it's a theoretical question, a current events discussion. He tells his dad, yes, absolutely, they're toast. They're going to zero. And then silence on the other end of the line. Just dead, heavy silence. And that's when his father admits the truth. It turns out he hadn't just been reading the news. He had a significant portion of his liquid net worth invested in Lehman Brothers bonds.
Oh, that is just gut-wrenching. You can feel the stomach drop just hearing that.
It's awful. Yeah. And it gets worse. His father hadn't gone out and picked these bonds on a whim. It wasn't day trading. He was sold them. A private banker at a major reputable institution, someone his father trusted, had pitched them to him.
Let me guess. Pitched them as safe.
Pitched them to him as AAA rated, safe as houses. Don't worry, Mr. Spier, these are solid, government-backed quality.
This is the authority bias we talk about so often. The nice man in the suit at the big bank says it's safe, so I don't need to do my own homework. It's so easy to fall into that trap.
Precisely. And Spier was just furious. He describes this toxic mix of rage and shame. He felt humiliated. Here he is, a professional money manager, spending his life trying to be rational, warning people about Wall Street sharks, and he failed to protect his own father from a salesman.
It really highlights that vulnerability, doesn't it? You can be the smartest guy in the room, but if your environment or your family's environment isn't inoculated against that sales pressure, you can still get hit.
The bonds went to zero, of course. The money was just gone. But this incident, combined with the general market crash where everything was down 40–50%, pushed Spier into a very specific psychological state. He talks about something he calls cocaine brain.
I love this phrase, even though it's terrifying. Cocaine brain. Because usually when we hear cocaine and Wall Street, we think of the 1980s, we think of greed, the Wolf of Wall Street partying. But he's using it to describe fear, right?
He is. He's describing the neurochemistry of extreme stress. We usually associate that rush of dopamine, that cocaine brain high with greed. When stocks are going up, you feel invincible, you feel brilliant, you feel high. But Spier points out that fear acts on the brain in a very similar and just as blinding way.
It's the amygdala hijack, fight or flight.
Exactly. When you are under that level of threat, your fund is down 50%, your dad has lost his money, the news is saying capitalism is ending, your amygdala floods your brain with cortisol and adrenaline.
And biologically, what does that do to your decision-making? I mean, to the rational part of your brain?
It shuts it down. It shuts down the prefrontal cortex. That's the part of your brain that does math, that thinks about the long term, that weighs consequences. It literally goes offline. You revert to a primitive reptilian state.
So you're not an investor anymore.
You're not analyzing balance sheets anymore. You are just a cornered animal looking for the exit. You are looking for relief from the pain.
That explains so perfectly why people sell at the bottom. It's not a financial decision. They aren't selling because the math says sell. They're selling because they want the anxiety to stop. They just want the hurting to end.
And Spier saw this happening to people he respected. He tells this incredible story about an analyst who worked for him. A smart guy, a self-proclaimed value investor. This guy knew all the theory. He'd read Graham and Dodd. He knew that when prices drop, you're supposed to buy.
It's the one thing you're supposed to do.
That's the whole point of the job. But right at the bottom of the market, in late 2008, early 2009, arguably the best buying opportunity in a generation, this analyst walks into Spier's office and says, I sold everything in my personal account, I'm in a cash.
Wow. That is the ultimate capitulation. That is the very definition of buying high and selling low.
It is. And it shook Spier to his core. He realized that if this guy who does this for a living, whose job is to be rational, is cracking, then the pressure is just immense. So Spier did something very counterintuitive. He realized he had to protect his brain from the data.
What do you mean?
He turned off the machines.
Literally, like unplugged them.
Literally. He turned off the Bloomberg terminal. He stopped looking at the prices. He realized that staring at the red numbers flashing on the screen was just feeding the cocaine brain. It was just another hit of cortisol.
So he went dark. In the middle of the biggest financial event of our lifetime, he just stopped watching.
He pulled out Marcus Aurelius's Meditations. He read Stoic philosophy. He tried to channel Buffett and Munger. He asked himself, what would they be doing right now? And the answer was not panicking in front of a screen. He realized that the only way to survive the firewalk was to detach from the noise entirely.
And because he detached, because he created that quiet space, he was able to do what value investors are supposed to do.
He bought.
He bought.
While everyone else was panic selling, he was buying. He mentioned specific examples like London Mining, Brookfield Office Properties, Cressud. He was buying assets for pennies on the dollar because he wasn't staring at the flashing red lights. He was looking at the underlying value of the assets.
It's the ultimate irony of the whole situation. He calls it a near-death experience for the fund, and it was. But those decisions he made in the quiet of that crisis laid the groundwork for massive future returns.
But, and this is the crucial pivot point for the rest of our deep dive, he knew he couldn't rely on willpower alone next time. He survived 2008, sure, but he realized, I can't just white-knuckle this every 10 years. I barely made it. He needed to change his life.
He needed a new system.
A whole new system.
Which brings us to Section 2, Designing the Environment, or as he calls it, my own version of Omaha.
This is such a profound shift in strategy. The core argument here is that the human brain, even a smart one, even a Harvard MBA brain, runs on about 12 watts of power. It is irrational, it's emotional, and it's weak. And you cannot think your way out of irrationality. You have to design an environment that prevents it from happening in the first place.
So if you're trying to quit sugar, you don't keep a box of donuts on your desk and just tell yourself, I'll use my willpower, I just won't eat them.
No. You throw the donuts in the trash, you don't even bring them into the house.
Right. And for Spier, New York City was the box of donuts.
The box of donuts. He calls it the vortex.
Vortex. I think anyone who has lived or worked in a major financial hub, New York, London, Hong Kong, knows that feeling. It's the constant buzz, the energy.
It is. It's the meetings, the lunches, the who's doing what, the gossip, the envy. It's a constant call to action. Everything in New York screams, do something, trade, network, sell, react. And that is absolutely deadly for a value investor whose entire job is to sit on their hands and do nothing for years at a time.
So he moved to Zurich?
He packed up his whole life, his family, and moved to Switzerland.
Okay, but why Zurich specifically? I mean, the chocolate is great, the mountains are nice, but why there?
Because it's boring. And I mean that as the highest possible compliment in this context.
Right. It's not a criticism.
It's quiet. It's orderly. It's a million miles away from Wall Street, mentally. He wanted to clone Warren Buffett's isolation in Omaha. in Mohnish Pabrai's setup in Irvine, California. He wanted distance. He wanted to break the feedback loop of the New York crowd.
There's some interesting science behind this too, isn't there? The whole idea of mirror neurons.
Right. There's a real biological phenomenon. When you are physically surrounded by anxious people, your brain mimics their anxiety. If you are on a trading floor and everyone is yelling and panicking, your heart rate goes up. Your palms get sweaty. By moving to Zurich, Spier physically removed himself from the herd.
But he didn't just move cities. That's the macro change. He redesigned his actual office. He got really granular with this environmental design.
He did. He created a physical space that was engineered to slow him down, to force deliberation. For starters, he has a quiet room.
Describe the quiet room. What's in there?
That's the thing. It's about what's not in there. It's exactly what it sounds like. No phone, no computer, no screens of any kind. Just books, reports, and a place to sit. It is a place for deep thought, not for reaction.
So in a world where every trader has 4, 6, 8 monitors, he built a room with 0.
Precisely. And speaking of monitors, remember the Bloomberg terminal? The thing he called informational crack that he turned off during the crisis?
Yeah.
He realized he was addicted to it. So in his new office, he physically positioned the terminal so it wasn't easily viewable from his desk. He has to get up and walk over to check it. For a while, he even removed his personal login to add friction.
I love that concept, adding friction to your own bad habits. You know, most tech companies are obsessed with removing friction one click by. He's doing the opposite. He's adding clicks.
He wants it to be hard to check a price. He wants it to be a deliberate choice, not an unconscious reflex.
He also changed his commute, didn't he? Another small but significant detail.
He modeled it after Buffett and Pabrai. A short 12-minute walk or a quick tram ride. It's not just about saving time. It serves as a decompression zone. It's all about keeping the cortisol levels down so the prefrontal cortex can actually work.
That makes sense. If you arrive at work stressed out from a 90-minute commute in traffic, your decision-making is already compromised before you've even had your coffee.
You're already in fight or flight. And he put things on the wall, not stock charts, not a TV with CNBC playing in the background.
No. He put up photos of his father, his brother, his earliest investors.
That's interesting. Why? I mean, is it just sentimental?
No, it's a fiduciary trigger. That's what he calls it. When you look at a stock chart, a ticker symbol, you see numbers, you see a game, it's abstract. But when you look at a photo of your dad or your aunt or the person who trusted you with their retirement savings,
You think about risk differently.
completely differently. You think about protection. It grounds you in the reality that this is real money belonging to real people with real lives. It personalizes the capital.
Okay, so he's got the environment set up. He's in quiet Zurich. He's got his dad's photo on the wall. But his internal attitude changed too. It wasn't just about being stoic and detached. He started talking about playfulness.
Yes, Section 3, a new spirit. This is where he moves away from viewing investing as gladiatorial combat.
Which is how most of Wall Street views it, right? I'm going to rip your face off. Eat what you kill.
Right. Kill or be killed. Spier realized that if you are tense, if you feel like every single decision is life or death, your vision narrows. You get tunnel vision. You miss things. Stress literally makes you stupid.
So he wanted to emulate Buffett's joy. That famous image of Buffett saying he gets to tap dance to work.
So how do you operationalize joy? That sounds nice, but how do you actually do it?
He started playing games.
Yeah.
Serious games. Specifically, he uses bridge and chess as mental models for investing.
Let's break those down. Bridge first. Buffett plays bridge constantly. It's his thing. What's the lesson there?
Bridge is a game of incomplete information. That's the key. You only see your own cards. You don't know for sure what your partner has, and you certainly don't know what the opponents have. You have to infer the distribution of the unseen cards based on the bidding and the play. It's all about probabilistic thinking.
Which is exactly like the stock market. You never, ever have all the information.
Never. You can read every 10K, every report, but you don't know what the CEO is thinking in the shower. You don't know if a key engineer is about to quit. You don't know if a competitor is about to launch a new killer product.
So he applies this to something like ranking stocks, right? Like JP Morgan. He realized he could never fully understand every single line item on a $2 trillion balance sheet. It's just impossible.
No human can. So what do? Just guess no. You make probabilistic inferences, like in bridge. You look at the management, that's the player. You look at the franchise value, that's the hand strength, and you calculate the odds. He stopped trying to know everything, which just causes anxiety, and started thinking in terms of making good bets with the odds in his favor.
And what about chess? That's a bit different. It's a game of perfect information. Both players can see the whole board.
True, but chess is all about pattern recognition and, crucially, avoiding blunders. Spier talks about the concept of the duffer move.
The duffer move, that sounds like something I do on the golf course.
It's the same idea. In chess, a duffer move is a silly, unforced error, a stupid blunder. You just leave your queen exposed because you weren't paying attention for a second. Panic selling in 2009 was a duffer move. It wasn't that the market was tricky, it was that the investor made a basic emotional mistake. The goal is to avoid those first.
He also states Lasker's rule, named after the world chess champion Emanuel Lasker.
When you see a good move, look for a better one.
Oh, that's so good. Because in investing, you so often find a stock that looks cheap, it looks like a good move, and the impulse, the greedy impulse, is to buy it immediately before it gets away from you.
Right. But Spier learned to pause, to take a breath. Okay, this is a good move. Is there a better one? Is there a better use of this capital somewhere else? It forces patience and discipline. He applies this to his investment in BYD Auto.
The Chinese battery and electric car company.
Right. He saw Charlie Munger and Li Lu, two investors he deeply respects, investing in it. That's a pattern. He connected the dots and realized this wasn't just a car company. It was a play on battery technology backed by some of the smartest minds in the room. He realized it was a better move than many of the other good moves he was looking at.
It's fascinating how he uses these games to retrain his brain. But let's get into the hard rules. Section 4, the toolkit. Because games are fun, but sometimes you just need a strict, unbreakable rule to stop you from doing something stupid.
These rules are what he calls circuit breakers. They're designed to short-circuit the emotional brain before it can do any damage.
Okay, rule number 1, check stock prices infrequently.
We touched on this with the Bloomberg terminal, but he codified it.
Yeah.
He argues that prices are a call to action. Every time you see a price change, up or down, your brain immediately asks, should I do something? Should I buy? Should I sell?
And that just creates this low-level, constant anxiety.
Exactly. So his goal is to check once a week, or even less.
Once a week. Isn't that irresponsible? I mean, you're managing millions of dollars for other people. Don't you need to know if the market is crashing?
See, that's the common pushback. But Spier would argue the exact opposite. If you are a true value investor, you are buying businesses for the next 5 to 10 years. Does the price movement on a Tuesday morning fundamentally change the value of that business over the next 10 years?
Probably not, no.
Then it's noise. And if it's noise, it's a distraction. And if it's a distraction, it leads to bad decisions. So ignoring it is actually the most responsible thing to do for his clients.
That requires a level of discipline that's hard to imagine. Okay, rule number 2 might be my favorite. The sales rule. If someone tries to sell you something, don't buy it.
It's so brutal, but so effective. Spier argues this is all about adverse selection. Think about it. If a broker calls you out of the blue to pitch a stock or a fund, why are they calling you?
Because they want to make a commission?
Right. And if the investment was truly a screaming bargain, a guaranteed home run, would they be cold calling strangers to sell it? No. They'd be buying it themselves or telling their best friends or their biggest clients.
So if it's coming to you via a sales pitch, it's probably the leftovers, the stuff no one else wanted.
That's his assumption. So he avoids IPO's initial public offerings entirely. An IPO is basically a sophisticated auction designed to maximize the price for the seller. By definition, it's almost never a bargain for the buyer.
Okay, rule number 3, the human egg theory. This is a very vivid metaphor.
It's a great one. Comes from Charlie Munger. The idea is that the human mind is like a reproductive egg. As soon as the first sperm gets in, the egg has a biological mechanism that slams the door shut. It hardens the outer wall to prevent any other sperm from getting in.
Okay, a little weird, but I'm following.
Munger says our minds do the exact same thing with ideas. Once you latch onto an idea, this stock is great. Your brain blocks out contradictory evidence. It's confirmation bias on steroids. You only look for reasons you're right.
So once you decide you like a stock, you just stop listening to the reasons why it might actually be a terrible investment.
You're deaf to it. So Spier developed a strict order of research to combat this. He wants to control which sperm enters the egg first.
So what's the sequence? How does he do it?
He starts with the driest, most boring, most factual sources possible. Corporate filings, the 10Ks, the 10Qs, the proxy statements, just the raw numbers and the legal text.
No stories, no spin, no narrative.
None. Then, step 2, he moves to earnings calls and management commentary. This is slightly more biased because management is obviously trying to spin a positive story, but it's still primary source material.
Okay, then.
Then, and only then, does he look at press and news articles. which are highly sensationalized and noisy. And finally, and this is the most crucial part, he reads equity research and broker reports last, if he reads them at all.
Because if you read that glowing analyst report first, that sperm enters the egg, and you just adopt the analyst's opinion as your own.
Precisely. You get anchored to their price target and their narrative. He wants to form his own independent view based on cold, hard facts before he ever hears the sales pitch or the market consensus.
That is really, really smart. It's a system to protect your independent thinking. What's rule number 4? Trading hours.
Do not trade when the market is open.
Wait, how do you trade if the market isn't open?
You send the order to your broker to be executed, but you make the decision and you send the instruction when the market is closed, after hours or in the morning before the open.
I see. So you aren't reacting to the flashing red and green lights on the screen.
Right. You make your decision in the cool light of day or the quiet of the evening. You sit in your quiet room. You decide, I want to buy 10,000 shares at this limit price. You write the email to the broker. You press send. Then you go for a walk. You completely remove the adrenaline of the ticking tape.
And the last one, rule number 5, the 2-year rule. This one sounds painful.
It comes from Mohnish Pabrai. The rule is simple. If a stock drops after you buy it, you are not allowed to sell it for 2 full years.
2 years, even if it's tanking, even if you realize you made a huge mistake, even if the CEO gets arrested.
Even if it's tanking.
Why on earth would you inflict that on yourself? That sounds like psychological torture.
There are 2 brilliant reasons. One, it short-circuits the emotional urge to sell just to stop the pain of a loss. We're hardwired to hate losing money. It's called loss aversion. So our instinct is to sell to make the bad feeling go away. This rule forces you to sit with the pain and be rational.
It's a straitjacket for your emotions.
It is. But more importantly, reason number 2, it forces extreme due diligence before you buy. If you know deep in your bones, hey, if I buy this, I am married to it for 24 months no matter what, you're going to research it a hell of a lot more carefully than if you think you can just flip it next week if it goes wrong.
It raises the bar for entry. It makes the act of buying a much heavier, more serious decision.
Exactly. It prevents impulsive buying, which is the enemy of good returns.
These rules are great, but Spier didn't stop there. He borrowed a concept from medicine that became really the centerpiece of his whole process. Section 5. The checklist.
This is one of the most famous parts of his methodology, and it was inspired by Atul Gawande's amazing book, The Checklist Manifesto.
A fantastic book. Everyone should read it.
Absolutely. Gawande, who's a surgeon, noticed that other surgeons who are brilliant, highly trained people were making simple, fatal mistakes. They were causing infections, operating on the wrong site, even forgetting instruments inside the patient.
Not because they were stupid.
But because surgery is just too complex, there are too many steps to remember under pressure. So they implemented a simple checklist. Did we wash hands? Is this the right patient? Is the blood type matched? And death rates just plummeted.
And Spier realized investing is the same.
It's the same problem, but he makes a key distinction. The checklist is not a recipe or a how-to list. It's a failure prevention list.
That's a really important distinction. It's not step 1, find a cheap stock.
No, it's step 1. Are we about to do something stupid that we've done before? Spier's checklist is entirely 100% based on his own past mistakes. He calls the process of creating it doing postmortems.
I want to dig into these because the specific failures are so instructive. Let's look at the Tupperware case. Everyone knows Tupperware. It seems like a simple, great business. Why did it make the failure list?
So Spier looked at Tupperware, and on paper, it was a cash machine. High margins, great brand, great return on capital.
Yeah.
But he missed the ecosystem view. Tupperware relies on an army of independent consultants to sell the bowls at parties. It's basically a multi-level marketing structure.
Right.
And Spier realized too late that while the company was winning, the consultants were losing. The market was saturated. The people on the ground doing the actual selling weren't making any money. They were churning out. They were quitting.
So the foundation of the business was rotting from the inside. You can't have a thriving business if your sales force is starving.
Exactly. It wasn't a win-win.
Yeah.
So he added a very specific item to his checklist. Is this business a win-win for the entire ecosystem? Do customers love it? Do employees love it? Do suppliers love it? If the answer is no for any of those key groups, the business is fragile. Eventually, it will break.
That is such a deep insight. It forces you to look way beyond the spreadsheet. What about the CarMax example? Again, that seems like a solid business. Used cars aren't going away.
CarMax is a great business. But in 2008, Spier owned it, and it tanked hard. Why? It wasn't because people stopped wanting to buy cars. It was because CarMax couldn't finance the cars for its customers.
They needed the banks to lend money to their customers to buy the cars.
And they needed the securitization markets to be open so they could bundle those loans and sell them off. When the credit markets froze solid in 2008, that entire window slammed shut. CarMax was totally dependent on a machine it couldn't control.
The checklist item became,
Is this company's revenue or survival dependent on the kindness of strangers? Or, more technically, is it leveraged to the credit markets? If a company needs Wall Street to be functioning perfectly every single day just to operate, Spier isn't interested anymore. He wants companies that are self-sufficient.
it's almost like he's building a fortress. Every checklist item is another gate that he closes so the enemy can't sneak through.
That's a perfect analogy. The checklist isn't about finding the upside. It's about welding the back door shut so you don't get robbed in the middle of the night.
Let's talk about one more failure because this one is purely psychological. Smart, balance, and discover.
This is the ego trap. This is a tough one to admit. Spier realized he bought these stocks partly because they were really complex. They had complicated financial structures, and analyzing them made him feel smart. It stroked his ego.
Look at me. I understand this complicated derivative structure that no one else gets. I must be a genius.
Exactly. He was buying them to satisfy an emotional need. The need to feel smart, not a financial one. So the checklist item is brutally, painfully honest. Am I buying this to satisfy an emotional need, like proving I'm smart?
That requires a level of self-awareness that is so rare on Wall Street. Usually the whole game is trying to prove you are the smartest guy in the room.
And that leads us perfectly into Section 6, doing business the Buffett-Pabrai way. It's a total 180-degree rejection of the typical Wall Street ethos.
Yeah, Spier talks about the contrast between the 48 Laws of Power, that famous or infamous book by Robert Greene, and the way Buffett operates. The 48 Laws of Power is basically a Machiavellian handbook, isn't it?
It is. It's all about pose as a friend, work as a spy, crush your enemy totally. It's about domination and manipulation.
Yeah.
And Spier used to think that was how you had to be to survive in New York.
But then he met Mohnish Pabrai and he watched Buffett up close.
And they operate on the complete opposite end of the spectrum. Their operating system is authenticity and generosity. Spier calls relationships the killer app, but not in a transactional, networking, what can you do for me kind of way.
He talks about the charity lunch with Buffett. He and Mohnish paid $650,000 for that lunch. At the time, that was a huge chunk of his net worth.
It was a massive bet, but he realized during the lunch that Buffett wasn't there to extract value. Buffett didn't need the money. Buffett was there to give value, to teach, to be authentic, to share his wisdom. And Spier realized that the most successful people in the world weren't the grabbers, they were the givers.
And Spier tried to adopt that himself. He talks about compounding goodwill.
Simple things, writing thank you notes, real handwritten notes, building a community, which he did with ValueX, a conference where people just come to share ideas freely with no ego. And the story of Ian Jacobs is such a great example of this ethos.
Ian Jacobs applied for a job with Buffett, right?
He did. Now, you can just imagine how many people apply for a job with Warren Buffett. Thousands, tens of thousands. But Ian did something different. In the envelope with his resume, he enclosed a check.
A check to Warren Buffett, the richest man in the world.
A check to pay for Buffett's time. He calculated what Buffett's time was worth per minute, and he sent a check to cover the few minutes it would take him to read the letter.
That is an incredibly bold move.
It signaled extreme respect. It signaled, I know I'm asking for something valuable, and I am not a leech. I'm not here just to take.
Did he get the job?
He got the interview. He didn't end up getting the job, but he built a relationship, and eventually he became a very successful investor in his own right, and actually ended up investing with the Buffett family on other deals later on. It's about operating with an abundance mindset rather than a scarcity mindset.
Mohnish Pabrai does this too. He shares his best ideas freely. He's famous for it.
The Forex stock tip email. Pabrai will find a stock he thinks will go up 400%, a real home run, and he'll just email his friends and tell them, hey, check this out. I think this is a big one. He doesn't hoard the information. He believes that what goes around comes around.
It's a much more pleasant and probably more profitable way to live than constantly guarding your secrets and looking over your shoulder.
And that brings us to the final and maybe most important section, Section 7, the quest for true value. Because all of these tools, the checklist, the environment, the games, the generosity, they are all leading somewhere.
This is where we get really philosophical. Spier distinguishes between the outer journey and the inner journey.
The outer journey is the wealth, the Ferraris, the $6,000 coffee machine, which Spier freely admits he loves. He's not a monk. He likes nice stuff.
Sure, nothing wrong with that.
But the inner journey is about self-knowledge and character. And this is where he connects investing to his own trauma. He calls it financial psychoanalysis.
That's a fascinating term. How does investing act as psychoanalysis?
Because investing exposes your inner fault lines. It shines a spotlight on all your fears and your greed and your insecurities. For Spier, he had to confront his family history. His family lost everything to the Nazis. They fled Germany. They were refugees with nothing.
So for him, money isn't just about luxury. Money equals survival.
Money is safety. And that deep-seated wiring makes him risk-averse. It makes him fear debt. It makes him anxious about loss. He compares himself to Mohnish Pabrai. Pabrai watched his father go bankrupt multiple times in India, but it never destroyed the family. They just dusted themselves off and started over.
So for Pabrai, failure isn't the end of the world. It gives him a much higher tolerance for risk and volatility.
Exactly, because he doesn't equate bankruptcy with death. And Spier had this huge realization. He cannot be Pabrai. He cannot be Buffett. He has to accept his own psychological wiring.
And that is the ultimate conclusion of the book, isn't it? True success isn't just having the highest return on the board. It's becoming an authentic version of yourself.
Exactly. You build a strategy that fits you. If you are anxious by nature, you build a safe, diversified portfolio. If you're aggressive, you concentrate your bets. But you have to stop trying to copy someone else's personality. You have to design the game you can win.
So we've gone from the absolute panic of 2008 to moving to Zurich, to playing bridge, to building a checklist to prevent mistakes, and finally to understanding your own soul. It's quite a journey.
It is, and the deep dive here, the real takeaway, is that the greatest tool an investor has isn't a Bloomberg terminal or a complex spreadsheet. It is self-awareness. If you know who you are, if you know your own weaknesses, you can design an environment where you can win. If you don't know who you are, the market will find your weakness and it will destroy you.
A powerful thought to end on. If you want to dive even deeper, go read the book. It's truly fantastic. But for now, thank you for watching. Please like, share, subscribe, follow up in the next video. See you next time.